Very good morning, friends. So I hope you're all doing well. And most importantly, as I keep saying, I hope you've done your cumulative revision on Ind AS 103. So we have been discussing the standard on consolidation. I would say the base standard for a consolidation, that is business combination, Ind AS 103. And we've discussed a couple of issues. And in the previous session, we started a discussion triggered of the concept of acquisition accounting. As I told you that there are three kinds of accounting which are discussed in the standard. One is called the acquisition accounting. One is called the reverse acquisition accounting. And the other one is a common control transaction. Just to remind you, a quick mind maps before we go take the journey forward. I've given you that when there is a related party transaction, it could turn out to be a common control transactions generally. But if it does not meet the parameters of a common control, even a related party transactions could be an acquisition or a reverse acquisition. But if it is supposed to be an unrelated party, then generally either it becomes an acquisition accounting or it becomes a case of reverse acquisition. Then I divided the journey in terms of the acquisition accounting, and I said we would look at a 7-step model in terms of doing the acquisition accounting. And just to remind you the steps, we've covered 2 steps so far. We are on the step number 3. I'll give you a quick recap on step 1 and 2, and then we'll get deep into the step 3 today. And of course, the focus is on step 4. Step 4, which is on the calculation of the purchase consideration, that's going to take some time because there are a lot of issues relating to purchase consideration. So when we look at the acquisition accounting, the 7 steps are: first, you identify the accounting acquirer. So the legal acquirer is who pays a consideration, but it is not necessary that from the accounting point of view, the legal and the accounting acquirer are the same. They may be different. And that's the triggering point which decides the kind of accounting as well. So when you say that the accounting and the legal acquirer is the same, then it is a case of acquisition accounting. But when you say that the legal and the accounting acquirer are 2 different entities, then it becomes a case of reverse acquisition. So your very first step is going to identify whether it is an acquisition or a reverse acquisition accounting. The step number 2 is getting the acquisition date. The step number 3, now to be precise, has got 2 steps. One is a step number 3A, where you identify the deferred tax assets and liability. And I need to give you an exposure today on that as well. And then the step number 3B is terms of getting all the list of net assets acquired and the liabilities assumed. The step number 4 is the calculation of the PC. The step number 5 is NCI. The step number 6 is goodwill or the capital reserve. And finally, the step number 7, you get the acquisition entry, which is done in the books of the accounting acquirer and is done on the date of acquisition. Now, without taking much time, we're just going to take a quick recap on some main highlights in terms of step 1 as well as step 2. So let's make a little quick mind map in terms of the step 1 and the step 2. Now, I'm just going to give you the crux in terms of what we identified in the step number 1. So my focus, first of all, is on step 1, that is identifying who is the accounting acquirer. So I would say if I put a simple little crux on this particular concept, I would say there are 2 focus points what you need to look at. You need to first of all identify that, rather than looking at the purchase consideration, let's, I think, first look at that did we create a new entity or not? So is the new entity, or rather we can go the other way around, because when I gave you the chart earlier, I said, you look at new entities created or not, but I think now we should focus in terms of the PC. So when you say that the purchase consideration is mainly in terms of cash, or the purchase consideration is mainly in the form of shares. So the crux, what we decided, that if the purchase consideration is in terms of cash, it does not make a difference whether a new entity is created or not. So the focus in this case is, whether you create a new entity or not, it does not make any difference to me. The moment your consideration is in cash, undoubtedly the legal and the accounting acquirer is same. So in this case, we can say the legal as well as the accounting acquirer is the same. And that implies that it is going to be a case of acquisition accounting. It's not going to be a case of a reverse acquisition. The moment your purchase consideration is in cash, it is clear that it is a case of acquisition accounting. But if you say that the consideration is in shares, then we are definitely connected with that the new entity is created or not. So the new entity is not created, or you can say the new entity is created. So that is how you're going to look at, quick things in the question. In terms of step one, your focus should be PC is in cash, no further questions. The legal accounting acquirer is same. The PC is in shares, and in this case, a new entity is created. So when a new entity is created, we decided it is undoubtedly going to be a case of reverse acquisition. The legal and accounting acquirer, of course, is not the same. So in this particular case, we can say the legal and the accounting acquirer in this case is not the same. And when you say that a new entity is not created, you need to do some calculations of the percentages, which is pre and the post business combination. So this is one area which is going to be based on assessment. So here we can say it depends. You'll have to basically compute a percentage. You'll have to basically compute a percentage and then decide. It may be acquisition accounting, it may be a reverse acquisition. So in this particular case, we can say it can turn out to be an acquisition accounting. Okay, so that decides the fate in terms of things. So this is a summary chart which gives you the entire inputs in terms of how you would identify who is the accounting acquirer from the accounting perspective, looking at the substance over the legal form. Right, friends, I think that connects you well in terms of the step number one. Now let's go on to the journey in terms of step number two. I'm just highlighting the main crucial steps to you without getting into the nitty-gritties. We've already done our discussions, the detailed discussions on each of these steps. The second one is getting the date of acquisition, and I'm going to put this as DOA. That's date of acquisition. So let's, I think, quickly recap in terms of the parameters to decide the date of acquisition as well. And we said there are two concepts. One is the date of acquisition and one is the closing date. So we can say there are two important things in this case. So we can say in this particular case, there are two things. One is the date of acquisition versus the concept of closing date. So there are two different concepts, the closing date and the date of acquisition in this particular case. So when you say the date of acquisition, it is the date when you get a control. And when you say it is the closing date when the PC is discharged. When the PC is discharged. So this is the concept of the two dates. When you look at the date of acquisition, it is the date when you get a control. And when you look at the closing date, it is the date when the PC is discharged. So ideally, these two dates are generally same. So these two dates are generally the same. The closing date and the date of acquisition is same. But effectively, we decided that there is only one exception. The second exception, as I said, doesn't even exist in a practical life situation. So I think the only exception The only exception we are looking at to this particular case is where the date of acquisition is before. The date of acquisition is before the closing date. So your date of acquisition precedes the date of closing date. And in this particular case, we decided that this generally happens. This generally happens when there is a written agreement. So this generally happens when there is a mutual agreement between the acquirer as well as the acquiree. So if there is a written agreement, they can do that. But we also decided that the written agreement is not, conclusive enough. Because even if they mutually agree with each other to pass on the control before the PC is discharged, you need to further see that if this is subject to approval. So in this case, if it is subject to approval, you need to decide that in this case, can the control pass on or not? And if the subject to approval is something which is not substantive in nature, then it is possible that the date of acquisition proceeds. But if you say it is substantive, then it is not possible. So here the date of acquisition can precede the closing date, but in this case it cannot. You'll remember the case of Competition Commission of India, where the approval of the CCI was something which was substantive in nature. Even though the parties would agree that we are passing on the control, but since it is subject to approval by CCI, that becomes something which is substantive in nature. And therefore, in this case, the control cannot pass on. The control will pass only on the closing date. That was on the step number 2, giving you a quick summary on the step number 2. And now comes a journey on step number 3. Now, step number 3A, I've given you some basic inputs, but let's, I think, go a little more deeper. I'm just going to quickly recap the provisions of Ind AS 12, which you have done. So our discussion now starts on the step number 3, but I'm just, first quickly taking a recap in terms of Ind AS 12. So we said that in terms of step number 3, we're going to divide our inputs in terms of 2 sub-steps, the step number 3A and the step number 3B. Now, in terms of step number 3A, everything depends upon whether the tax rate is given in the question or not. So in this particular case, if you are not given a tax rate, then in this particular case, this step is not applicable. If there is no tax rate, then I'm saved with the trouble of applying Ind AS 12, then nothing is to be done. You can go to step 3B. But if you say that the tax rate is given in the question, then in this particular case, the concept of Ind AS 12 will trigger. We will apply the concept of Ind AS 12. Now, I'm just reminding you the inputs which you have already done in Ind AS 12, income tax standard, the concept of deferred tax asset and liability. Now, what you need to first of all remember, and which is logical, is that in the books of the acquirer, you are putting an acquisition entry where all the assets and liabilities are taken at a fair value. So the carrying amount in this case effectively is equal to the fair value. But as far as the tax base is concerned, that is going to be based on original cost of the asset. Because income tax authorities will give you a deduction which is based on the original cost of acquisition. So when you revalue the asset for the purpose of Ind AS 103, the book value is the fair value. But the tax base is based on the original cost. So book value and the tax base will definitely differ. So what do you need to do in this particular case? In this particular case, what we need to do, we need to identify all those assets and liabilities. We need to identify all those assets and liability. We will identify all those assets and liability. You can say whose carrying amount, that is the book value, is equal to fair value, which is not equal to the tax base. Get the list of all those assets and liability whose book value is equal to the fair value. but that's definitely not equal to the tax base. So we will either get a taxable temporary difference, or we will get a deductible temporary difference. So we will get two differences, either they are taxable or they are deductible in nature. This is what we're reminding in terms of Ind AS 12. So we will get a taxable or a deductible temporary differences. And just to remind you, in terms of taxable and deductible differences, if it is a case of asset, you can say the carrying amount which is equal to the fair value is greater than the tax base. And if it is a deductible difference, the carrying amount which is equal to the fair value is less than the tax base. Now, this is what I'm just taking a recap on the Ind AS 12 perception. And if you're talking in terms of liability, then the carrying amount which is equal to the fair value is less than the tax base. And for this, the carrying amount which is equal to the fair value is greater than the tax base. So you need to be very clear that which differences are taxable and which differences are deductible for assets and liability. And we also know well in advance that taxable differences will lead to a DTL and deductible differences will lead to a DTA. So once you multiply the taxable differences into a tax rate, you're going to get a DTL. When you multiply the deductible differences into a tax rate, you are going to get a DTA. So this is one exercise which you need to apply before you make a list. Get all the net assets which are taken at a fair value. Compare the fair values and the tax base, get the differences as taxable and deductible in nature, and that will give you the DTL on the taxable differences and a DTA on the deductible differences. Right, friends, I think that gives us a good recap and the additions in terms of Ind AS 12. Now I'm back to my focus in terms of the step number 3B. That was quick insights. Step number 1, getting the accounting acquirer. Step number 2, getting the acquisition date. And the step 3A, which is application of Ind AS 12 if the tax rate is given. All good, I guess. If you made revisions, this would have endorsed your concepts further. Say yes. Now let's go further on this. I'm now going to take it to the third step with you. That's wonderful indeed. So, okay, now let's go on to the next one. That is step number 3B. Now, in this case, I had already given you the thought process. Today, we're going to work upon the step number 3B. That is getting the list of net assets. That is making a list of the net assets with us. And I think now let's quickly recap and understand that when you're making the list of the net asset, what goes in the back of the mind. The general thought process is that let's say this is the balance sheet of the acquiree. I mean the accounting acquiree. And let's say this is the journal entry to be done in the books of the acquirer. That is the accounting acquirer. Now, I'm just going to ask a few questions as well. Let's get your thoughts also very clear. So we got a balance sheet of the acquiree and we're looking at the journal entry in the books of acquirer. Now, I'm going to give you 4 situations. So can I say the assets and liabilities which are appearing here at a book value, can I say they will appear out here and this is generally at a fair value? Can I say this is the thumb rule? Correct? So if you ask me, I would say this is the basic thumb rule which we decided, that all the assets and liability which are in the balance sheet of the acquiree also appears in, you can say, the journal entry at a fair value. But then we looked at certain exceptions. And we looked at a total of 3 exceptions. So I think let's not number this one. Let's number the exceptions as 3 exceptions. The assets and liabilities which are appearing here at a book value they also appear here at a book value itself. They appear here at the book value itself, and this is called the measurement exception. This is what we said is called the measurement exception. Would you like to tell me that in this case, how many measurement exceptions are present? I gave you a list of the items, a total of 8 exceptions in total. And would you like to remind me how many exceptions are there as far as the measurement aspect is concerned? Okay, I think I got some answers on that. And the number of exceptions in this case you said is 3. That's wonderful indeed. So there are a total of 3 exceptions. We'll come to that very soon. I'll come back to the chart. Then we decided that in terms of the second area, the assets and liabilities are not appearing, but those assets and liabilities will appear, and they will appear at a fair value. And that is called recognition exception. That is called the recognition exception. And how many recognition exceptions were there? That's called recognition exceptions. And how many recognition exceptions was there? Can I say just one? Contingent liability. And that's right. So this was one exception. And finally, the assets and liabilities are not in the balance sheet of the equerry, but those assets and liabilities will appear, and it is other than fair value. It's not at a fair value, but other than a fair value. And this is called recognition and measurement exceptions both. And I think if you recall, there were 4 numbers out here. So total of 8 exceptions, which I gave you is a chain of thought. So far, so good. Now we are going to work upon these exceptions with you. So we're going to work upon these exceptions. A few, as I said, typically the share-based payments and the concept of reacquired rights. Don't even apply your mind. What is that reacquired rights or share-based payments? So share-based payments and reacquired rights we'll discuss later. Deferred tax we've already considered in step number 3A. So out of 8, 3 items done. Okay, now I think let's go further. I'll just now quickly take you to the chart and we'll discuss some inputs in the study material. I shared you the chart the other day as well. We're just going to go back and look at that interesting chart which is given in the study material. So let's have a look at this chart. So I'll just zoom it across, crop this so that we can see it better. I hope it's visible to you. I hope it's manageable, right? So, but maybe a little small, but I hope that stands still manageable. We'll just quickly look at the inputs now. So we decided that there are recognition exceptions. And the only recognition exception is the contingent liability. And where we need to consider if it is the fair value can be measured reliably. I'll go in a little more detail. I'll go in a little more detail on this contingent liability. We'll discuss this. I'm not done. We'll discuss this. Then we can see that there is measurement exceptions. And in the measurement exceptions, we've got share-based payments, which we'll take care in step 4. Then we've got reacquired rights we'll discuss in step number 4. So we'll discuss the reacquired rights in step 4. Then there is assets held for sale. And this we will apply Ind AS 105. So this is 1, this is 2, and this is 3. So we're going to discuss this number 2. Already discussed. Already discussed. The NCA held for sale is going to appear at a fair value less cost to sell. The way it is appearing in the balance sheet of the equerry, it appears as it is in the journal entry as well. And then comes recognitions and the measurement exceptions, in which case we've got 4. Income tax taken in step number 3A. Employee benefits as per Ind AS 19. And leases, that is another exception, which is based on Ind AS 116. And indemnification assets. So employee benefits indirectly discussed, and indemnification we will discuss, leases indirectly discussed. So we need to focus in terms of contingent liability, in terms of indemnification assets. That's it. So basically, rest already discussed or rest is there, but I'll still map it up. I'll still map it up so that you're very crystal clear where do you need to take these items. So what I'm going to do, I will just come back on the agenda. I'll just come back on the chart and fit it out there. Then we'll start discussing these exceptions. Let me just put them at the right place. So in terms of my step number 3B, in terms of the step number 3B, let's quickly make a list to be very clear. So when I'm looking at the list of the net assets, you need to consider these 8 items at the back of your mind. But we'll be very clear that which are these items. So let's, I think, quickly pen them down and we'll see which one to be discussed. Then we'll start discussing one by one. So one is the recognition exception. One is the measurement exception. And the other one is the recognition and the measurement exception. So we're looking at the exceptions. There are a total of 3 exceptions: recognition, measurement, and recognition measurement combined. Now, I'll just give you a list of what we're going to discuss so that you're very clear that what is discussed, what is yet to be discussed, and what we're going to discuss right now. So in terms of the recognition, we're looking at only one item, that is contingent liability. So I will discuss now. We will discuss this in detail now itself. That's one. Second, when I'm looking at the measurement, there are 3 items. Share-based payment, I'm putting it as SBP. Then there is reacquired rights. And then there is supposed to be NCA held for sale. So as far as the reacquired and share-based payment is concerned, this will be discussed later. This will be discussed in step number 4. I'm not skipping them. I'm saying we'll discuss them in step 4. So they will be taken care in step 4. Our minds need to be very clear. And in terms of NC held for sale, it will be same. It will be at same value as acquiry. It will appear in the same value as acquiry. That is supposed to be Ind AS 105. And when you say Ind AS 105, it is appearing at fair value less the cost to sell. So we're going to pick it as it is. So this stands discussed. So I don't need to discuss anything on the measurement exceptions now because 2 will be discussed later and 3rd is discussed. Then we come to the next one, recognition and measurement, and we've got a total of 4 items. One is the income tax, and this is already taken care in step number 3A. So this is already done. So this is already taken care. This is already taken care in step number 3A. So that's already done. So I don't need to discuss deferred tax as well. Done. Then there is indemnification assets. And this is what we're going to discuss right now in detail. And then there is employee benefits. Then we've got employee benefits. And we've got leases. So employee benefits and leases. And employee benefits will be as per Ind AS 19. And the leases will be as per Ind AS 116. So let's put this down. So as far as employee benefits are concerned, this is going to be purely as per Ind AS 19. Leases will be purely as per Ind AS 116. So discussed. So I'm not going to discuss the employee benefits or the leases in this case. Done. Now, as far as indemnification is concerned, we will discuss in detail now. So we will discuss this now. So I guess now you can be very clear on the thoughts what I need to discuss with you. I'm going to discuss the contingent liability. That's one. I'm going to discuss the indemnification assets. That is two. So my focus is in terms of discussing the contingent liability as well as the indemnification, because some items already discussed. I think this income tax 3A, employee benefits and leases 3, and this 4. Rest 2 items discussed later. I hope, friends, I'm very clear on my thoughts. So I'm just going to discuss 2 exceptions with you, contingent liability as well as indemnification assets in detail to understand the flow. So far, so good. I guess we are all stands clear to this. Okay, now let's proceed further. So I am now going to take you to the discussions on contingent liability. Now, please hear this carefully, because sometimes people tend to get confused and they get a little mixed up with the concept of contingent liability. Let me make one thing very clear, that when you look at the accounting in the books of acquiry, then what are the principles? When you look at the accounting in the books of acquirer, then what is the input? Now, so let's make it very clear. So I'm looking at the status. I'm looking at the status in the books of acquiry. I'm looking at the status of the acquiry. So what he did, he applied Ind AS 37. Now, friends, I'm going to revise, indirectly, just take a recap of the concepts you have learned in Ind AS 37. So you're connected with the concept of contingent liability. So I'm not going to give you any logics. I'm just reminding you what you have done in Ind AS 37. Let me, I think, first ask you a simple question. If somebody puts me a question, how many types of contingent liabilities are there? Would you like to give me a number? If somebody puts a question and tells you that as per Ind AS 37, how many combinations are there which could lead to a contingent liability? So would you like to give me some insights on that what is the number of contingent liabilities? So what is the number of contingent liability which appears in the books of the acquiry where he would have applied Ind AS 37? Okay, so I think I got some answer. Let me just, look at the answer. And you said 1. No. Okay, I think I'll give you the insights now. Now, watch this carefully. If somebody says that what are the types of contingent liability, I would say there are 3. One is called that there is a present obligation. But in this particular case, the outflow of cash is not probable. The outflow of cash is not probable. It is a present obligation, but it fails the criteria that the outflow is going to be probable in nature. The next one is that it is a present obligation and the outflow is also probable in nature. But in this particular case, a reliable estimate cannot be done. A reliable estimate in this case cannot be made. So this also becomes a case of contingent liability. So it's a present obligation with a probable outflow, but the estimation cannot be done. And in this case, there is another combination which is supposed to be a possible obligation. If you get a little more deeper, you would realize that there are basically 3 kinds of contingent liability. Because the basic input, what people remind is, if you tell them a contingent liability, they say possible obligations, thank you. But, trust me, even a present obligation can be a contingent liability because the outflow was not probable, because there are 3 recognition criteria. And it may fail the second, third, or first criteria. The first criteria is it's a present obligation. It fails that criteria. The second is it's a present obligation, but it fails the second criteria that the outflow is not probable, or it fails the third criteria that the reliable estimate cannot be done. So we can say that there are three kinds of contingent liability as far as Ind AS 37 is concerned. Now, when the acquirer acquires the acquiree, he will not apply Ind AS 37. So if you look at the things from the point of view, if you look at the things, the status from the point of view of the acquirer, when you look at the status from the point of view of the acquirer, he is not supposed to apply Ind AS 37. He is supposed to apply the parameters of Ind AS 103. So you can say Ind AS 103 overrides the requirements of Ind AS 37. So as an acquirer, when I acquire the business of the acquiree, I will apply the parameters of Ind AS 103 and not 37, which means I will capture those contingent liability. So I will capture those contingent liability whose fair value can be measured. So we will capture all those contingent liability as a part of the acquisition entry, and there is only one single parameter that the fair value can be measured reliably. So which means it doesn't make a difference to me whether it is a present or a possible obligation. Everything depends upon the fair value can be measured or not. It's a present obligation. And now let me also tell you one thing. If he cannot make a reliable estimate, then even in this case, fair value will not be determinable. In this case, if you can determine the fair value, it appears in the entry. If you cannot determine the fair value, it does not appear in the entry. And same goes the status out here. If the fair value in this particular case can be determined, it'll appear in the entry. If it cannot be determined, it'll not appear. So to put it in simple words, the only thing is if you are given the fair value of a contingent liability, it's a part of the acquisition entry. That's it. I hope I stand clear. So he decides the kind of contingent liability by applying the parameters of Ind AS 37, but as far as the acquirer is concerned, he is nowhere applying the concept of Ind AS 37. He needs to apply the status of 103. He's only going to put a question, is the fair value reliably measurable? If yes, put it as a part of the entry. If no, it's ignored. I hope I am pretty much clear on the thoughts. Okay, so this is on the contingent liability. We'll see the question later. Now let's also go to the next one, and that is indemnification assets. And that is indemnification assets. Now the question arises, what is an indemnification assets? So let's, I think, first of all, understand that what is the concept of indemnification assets. The word indemnification comes from the word indemnify. That if I am getting a loss, the other person indemnifies. Now let's consider an example to understand this. Let's say there is A Limited and let's say there is B Limited, and A Limited acquires the business of B. So he is the acquirer and he is the acquiree. So A is the acquirer and B is the acquiree. Now, B Limited has certain contingent liabilities. Now, B Limited in this case has got certain contingent liabilities. So these contingent liabilities will appear. These contingent liabilities will appear in the acquisition entry. So they will appear in the acquisition entry. If you can determine the fair value, then they will be captured. Now, A Limited tells B Limited, sir, these are contingent liabilities against you. These are court cases against you. And tomorrow, if these contingent liabilities materialize, why should I be liable? You should, compensate me for those liabilities. So today I take over a business, there are court cases against you, which you're showing as a contingent liability. But tomorrow, if the court cases are lost, why should I be liable? You should indemnify me. You should compensate me for all those losses. So B says, okay, I will compensate you. So for these contingent liability, he agrees to compensate. He agrees to compensate A Limited for all these indemnification assets. And this is what is called indemnification assets. So you can say that there is a contingent liability and there is a compensation against that contingent liability arising. A says that tomorrow this contingent liability fructifies, then you need to compensate me for the loss. And B says, okay, I will. But there is only one important input which you need to remember. There is only one important input which you need to remember. So I think let's put this across very simple and straight. If in the acquisition entry the contingent liability is not recorded, indemnification asset cannot be recorded. The only important input is if the contingent liability is not captured in the acquisition accounting, the indemnification asset can also not be captured. If the contingent liability is captured, the indemnification assets can also be captured, but not more than the contingent liability figure. If you record the contingent liability at 5 lakhs, indemnification assets cannot exceed 5 lakh. So the rule is simple. You capture the contingent liability in the entry, you can capture the indemnification assets, but not more than the contingent liability. You do not capture the contingent liability, you cannot capture the indemnification asset as well, because you cannot stand to gain out of this indemnification assets. You capture none of them. If you don't capture contingent liability, don't capture indemnification assets. But if you capture the contingent liability, please ensure that amount of indemnification assets cannot exceed the amount of the contingent liability. I hope I stand very clear on that. So now we are clear with the two exceptions, contingent liability and indemnification assets. My step number 3B is done, but we'll still do questions on this. Now you would say, so what about those intangible assets? Yes, as a part of the step number 3A, you also need to record those intangible assets as well. The intangible assets which were internally generated in the books of the acquiree could never appear in the books because of Ind AS 38. But when it comes in the journal entry, that is acquisition entry, those intangible assets can be recorded and they will be recorded at a fair value. But it's not mentioned anywhere as a part of the exception list. It is given as a separate discussion in the standard. So I think I'll just like to also put that as one single input, not as an exception, but just as a note. I'm just putting it as a note as well. So this is not an exception. We can say intangible assets of acquiree. Intangible assets of acquiree which were not appearing in balance sheet, because of Ind AS 38. So all those, you can say all those intangible assets which were not appearing in the balance sheet of the acquiree because of Ind AS 38 can appear in acquisition entry. They can appear in the acquisition entry in this case, provided you meet the recognition criteria. And they will appear at a fair value in the acquisition entry as well. Okay, so far so good. Let's now go further. Okay, so I think I'm getting a question. So any example of indemnification asset? Is it just a contract of indemnification such as an assurance? I'll very shortly take an example in the study material explaining the contingent liabilities and the indemnification assets both. No worry. So I think let's go to the illustration in the study material on this area. Okay, so I think let's have a look at the inputs in terms of contingent liability. So there is a wonderful example which is given out here. Let me, I think, share the inputs to you. So I'm first taking you to a small little example on Ind AS 37. I think this will be definitely visible. This is example number 15 in the study material. So let me just put the heading out here. So this is the case of contingent liability. So you can see the exception to the step number 3B. So this is the exception to the step number 3B, which is on the contingent liability. So let's have a look at this example. We'll look at the contingent assets as well. Okay, so let me just read the inputs. It says a suit for damages worth 10 million was filed on company B for alleged breach of certain contract provision. Company B disclosed the same as a contingent liability in the financial statements as it considered it is a present obligation for which it was not probable that the amount will be payable. Quick question. Can I say this is the second kind of contingent liability? Present obligation for which the outflow is not probable. I gave you three. Sorry, the first one. So the first one is present obligation, outflow not probable. The second one is present obligation, outflow probable, but estimation cannot be done. And the third is a possible obligation. Correct. So company A acquired the company B and determines the fair value of this contingent liability to be 2 million. So will this appear in the books of A as a part of the acquisition entry? Of course, yes. It's not in the books of accounts of B because of Ind AS 37. But A would apply the concept of Ind AS 103 and simply put a question, can the fair value be determined? If yes, it's going to be captured as a part of the acquisition entry. So company A would recognize this 2 million in the financial statements as a part of the acquisition accounting, even if it is not probable that the payment will be required to settle the obligation. Did you notice that? Even if the second step fails, even though the outflow is not probable, it does not make a difference. I want to still take it as a part of my list. Now you would say, why? Why does Ind AS 103 gives a different parameters to the acquirer and Ind AS 37 gives a different parameter? Remember, at the end of the day, when you compare the net assets versus the purchase consideration, you're going to get the goodwill of the capital reserve. And I think the goodwill of capital reserve needs to be the correct figure. If you're able to capture every asset and liability which is taken over at a fair value, only then the amount of goodwill is going to be a correct representation of the deal. I hope you got the point. Because when you make your list of net assets and you capture every asset liability at a fair value, and then you say that, okay, I paid this PC, the amount of goodwill or capital reserve is the real goodwill capital reserve. So the standard Ind AS 103 was very clear that I don't care whether outflow is probable or not. My only focus is that if you can determine the fair value, please put it as a part of the list of net assets so that I get the right amount of goodwill or the capital reserve on the deal. Okay, I think you would have got your answer on no, your indemnification is still pending. I'll come back to that. That's not an issue. Okay, so I think let's go to the next one now. So let me now consider another example in this case, and let's consider. So let me just, I think, take it a bit out here. So I might need some more things. The font may not be very clearly visible, but I guess we'll still manage. Okay, so I think this is visible. Example number 16, what I'm looking at. Okay, let's go to the next one now. It says company A acquires company B in a business combination on 1st April X1. B is being sued by one of the customers for breach of contract for 250. The sellers of B provide indemnification to A for the reimbursement of any losses greater than 100. So against the acquiring company, there is a legal case, and it says B agreed to compensate A, indemnify him for any losses greater than 100. There are no collectibility issues regarding the indemnification. Now, let me also tell you, that's also another important condition. If you want to capture the indemnification assets, there are two conditions to be put it precisely. One is the amount of indemnification assets cannot exceed the amount of contingent liability captured in the entry. And the second, there should be no collectibility issues regarding the indemnification. I'm pretty confident as an acquirer that the acquiring company will pay that money. He will indemnify me as well. So I think let's put down something out here. So this is on the indemnification assets. This is on the indemnification assets. To remind you, we are working on the step number 3B. We're working on the step number 3B, that is exception. So we're working on the example on the exception. So let's also put it down that indemnification assets. So there are two important, you can say, parameters. There are two important parameters which would apply. The first one is indemnification assets cannot exceed the value of contingent liability. And the second parameter is there is no collectibility issues. There is no collectibility issues. We are pretty confident that we'll get this money from the acquirer, from the acquiring. So these are the two inputs. Let's now read further. So I am now given the inputs. At the acquisition date, company A determined the present obligation, and therefore the fair value of the contingent liability is 250. So it says in the acquisition accounting, A also recognizes an indemnification asset of 150. So it says in this case, the sellers of B provided indemnification to A for any losses greater than 100. So if the loss is going to be 250, they say anything which is beyond 100, we bear it. So you bear up to 100, we bear the excess. So what is the excess? 150. So indemnification assets will get captured at 150. So in the acquisition entry, the contingent liabilities will appear at 250 and the indemnification assets will appear at 150. But let's say if they would have agreed to compensate, let's say 300, just thinking. If they say that we would compensate 300, can I say I'll restrict the indemnification assets to the extent of 250 only? I think you got your answer on that. Somebody asked me on the example on the indemnification. I hope you got your answer. That's great. Okay, wonderful indeed. Okay, let's now consider and let's go to the illustration number 15 as well. Let's have a look at illustration 15. It says ABC acquired a beverage company, PQR, from XYZ. At the time of acquisition, PQR is a defendant in the court case, whereby certain customers of PQR have alleged that the product contains pesticides in excess of the permissible levels that have caused them health damage. So there are some court cases by the customers against the company. Then he says PQR is being sued for damages of 2 crores. XYZ indemnified ABC for the losses, if any, due to the case up to 1 crore. The fair value of the contingent liability is 70 lakhs. Let me put a question quickly to you. The fair value of the contingent liability is 70 lakhs and the indemnification promises are 1 crore. Will you be able to capture indemnification assets in the entry at 1 crore or limited to 70 lakhs? I'm sure you'll give me the answer quick and correct. So in this particular case, will we capture the amount? And that's right, 70 lakhs only. How should ABC account for the contingent liability and the indemnification asset? What if the fair value of the liability is 1.2 instead of 70? So two parts. In the first part, we will recognize 70 lakhs. ABC measures the indemnified liability at 70 lakhs and correspondingly an indemnification asset of 70 lakhs. And therefore, the net impact on the goodwill is going to be zero. Because in the acquisition entry, if you capture the indemnification asset and you capture the contingent liability at 70 each, no impact on the goodwill. The goodwill is effectively not impacted. Then he says, however, where the liability fair value is more than 1 crore, it is 1.2 crores, the indemnification will be limited to 1 crores. And will there be impact of goodwill in that case? Yes, there will be impact on goodwill in that case, because you record the contingent liability at 1.2 and the assets at 1 crore. So 0.2 crores, the goodwill gets impacted in that case. Wonderful. Okay, so this is inputs done. And let's, I think, take another small little example as well. There's another illustration number 16. Let's, I think, do that as well to become more clear. It says ABC pays 50 crores to PQR from XYZ. So this is the purchase consideration which is paid. PQR manufactured the products containing fiberglass and has been named in 10 class actions concerning the effect of these fiberglass. XYZ agrees to indemnify ABC for the adverse results of any court cases which comes up. Let me just crop this up. It says he will indemnify to the extent of 10 crores. And there it says the classes of actions have not specified amount of damages, and past experience suggests that claims may go up to 1 crores each, but they often settle for smaller amounts. ABC makes an assessment of the court case and decides that due to the potential variation in outcome, the contingent liability cannot be measured. And accordingly, no amount is going to be recognized in the court cases. How would the indemnification asset be accounted for? Are you going to account it? Of course, no. I made a very clear-cut picture. No contingent liability, no indemnification asset. So in this particular case, since no liability is recognized, ABC will also not recognize the indemnification asset as a part of the business combination accounting. Okay, I think I got another question as well. So in example 16 and illustration 15, if the liability materializes at the actual contingency, then there will be a loss to the acquirer by the amount paid over the liability. I got your question. Now you're coming to a very interesting agenda, which of course, I don't know I'm going to touch much or not, but I'll definitely give you insights on that. You know, when you're looking at the exceptions in terms of step 3B, there are two things: accounting on the date of acquisition and the subsequent accounting. So that means when you've already captured these exceptions, then there is a guidance which is given in the standard, which also explains you the accounting, the subsequent accounting of those exceptions as well. So, but I think I'm not getting into all that, since my focus is on the accounting on the date of acquisition. I'm not really looking at this stage, the accounting on a subsequent level. But let me also tell you, there is another very interesting input given in the standard, and that is called a measurement period concept. That measurement period concept tells me that if there are anything which was recorded on the acquisition date, and that was not, something which was very certain, and there is something which happens at a later date, within 1 year from the date of acquisition, it leads to what is called a measurement period exception. We'll discuss that measurement period exception, not now, later. This is well discussed in the study material as well. It is something similar to the concept of IS 10. But I think what you're hinting towards is a subsequent changes in these assets and liability. How would you tackle them? I think that's the question. So wait till we come to the measurement period concept. Right? Great. Okay, so the mind is thinking absolutely well. I think that's right. Wonderful indeed. Okay, so this is the exceptions done. Now we are done with the list. That is step number 3B. I think now it's time to take you to the step number 4. So I'm done with the list of net assets. I'm now on step 4, which is the most important and the crucial step. That is step number 4. So in step 4, we're looking at the purchase consideration, and now you'll see that there will be a lot of inputs which I'm going to give you, and there will be a lot of things which you'll have to digest. Let's begin the journey. So I am coming to the inputs in terms of step number 4. Now, please hear this very carefully, because based on my insights on the standard, I have actually created a lot of list of issues in this case, which can be comprehensively taken. So I am working on what is called commonly as a purchase consideration. The standard uses the word consideration transferred. Or in simple words, you can call it as a purchase consideration. Now, at the first instance, let me put something in your mind. We'll work with a lot of examples on that area. Generally, I'm saying generally, when it comes to a purchase consideration, the PC is generally paid in cash, or it is given in the form of share exchange. A took over the control of the business of B. He tells the shareholders of B, I'll give you cash. Or he says that I will give you shares in my company against the shares acquired. So that's a share exchange. If it is a case of a share exchange, you will take the fair value of shares issued. As a part of the PC. So PC generally is going to be a sum total of the cash and the fair value of the shares issued. We'll add the two and we'll get the purchase consideration. Now, looking at the different insights given in the standard, I made a conclusion and I identified 7 issues related to PC. Now, this is not clearly given anywhere in the standard that there are 7 issues related to PC. That's my own work process. So there are a total of 7 issues related to the purchase consideration. I'll give you the list of those 7 issues, and then we're going to start working on the 7 issues. You know what? When you did Accounting Standard 14 at the intermediate stage, the purchase consideration is something which you would have finished in almost 15, 20 minutes, or at the max 30 minutes. Guess what? Today we're going to discuss the purchase consideration for the remaining entire tenure of this class. Isn't that interesting? We are going to spend almost 2 hours or maybe more than that on the concept of purchase consideration. Sounds wow. So let me now give you the list of these 7 issues. So I am giving you a list of 7 issues which I have identified, and that's going to make life simple. So there is a list of 7 issues relating to the concept of purchase consideration, and I've given some interesting nicknames. to make life simple. I'll give you the full names as well, but that's how you'll be able to easily remember those names as well. One is what I call DC. DC is what is called deferred consideration. The second one is what we call CC. That is CCS. So when I say CCS, it is called contingent consideration. It is called contingent consideration in the capacity of shareholder. Don't worry, we will understand each of these issues one by one in detail. So we will see this, but this is CCS, contingent consideration, which is paid in the capacity of the shareholder. Then it is CCE. And this is contingent consideration. paid in the capacity of employee. It is a contingent consideration which is paid in the capacity of the employee. Then there is next one that is called TC. Then this is called TC, that is called transaction cost. I think we made a mention of this earlier as well. So that is called TC, that is called transaction cost. Then the next one is what is called SBP. First we'll take PHI. The next one is called PHI. I think you heard this earlier also from me during the concentration test. It is called previously held interest. It is called previously held interest. That is called PHI. Then there is another agenda that is called SBP. And this is what you heard in step number 3B, but I said we'll discuss in step 4, that is called share-based payments. SBP, that is called share-based payments. And finally, we've got another agenda as well, and that is called pre-existing relationship. That is called pre-existing relationship. So this is the agenda, the list of 7 issues which we need to understand in terms of calculating a purchase consideration. So I have given you the inputs in terms of the 7 issues relating to PC: DC, CCS, CCE, TC, PHI, SBP, and a pre-existing relationship. So now we're going to discuss each of these 7 issues one by one in detail. Once you're clear with these 7 issues, you can handle any question on the concept of a purchase consideration. There can be questions on any one of these issues. You can get independent questions on CC. You can get independent questions on a PHI. You can get independent questions on share-based and pre-existing relationship. TC is too small to get independent questions, and of course this also get covered. And even DC, you can get a small little question as well. So except TC, you can get questions on each and every issue independently as well. That means only one particular issue, there is a question which can come. Right, friends, now I think let's begin with our inputs on each of these elements one by one. So I'm going to first of all explain you the 3 concepts together. I'll cover 3 issues together. I'll cover the concept of DC, I'll cover the concept of CCS and CCE, all 3 jointly. Why I'm comparing them? Because there are some similarities and some differences in these 3. So I will do the discussions in terms of these 3 agendas together. So I'm going to explain you the concept of these 3 issues together. We'll cover 3 agendas together. One is the concept of DC, one is the concept of CCS, and one is the concept of CCE. So let's understand this one by one. Now, when I say a deferred consideration, the acquirer tells the shareholders of the acquiree that I will pay you at a future date. So when I say a deferred consideration, this means it is paid later. This means it is paid later. As far as a contingent consideration is concerned, the acquirer tells the shareholders of acquiree, I will pay at a later date if certain conditions are met. If certain conditions are met. So in terms of DC, it is paid later, but it is a confirmed payment. So you will definitely pay at a later date, but it's a confirmed payment. Dunga, lekin baad mein dunga. Dunga pakka, lekin baad mein dunga. So it's a confirmed payment. It's a confirmed payment to be paid at a later date. And this is what is paid later. What is paid later, but it depends upon conditions met. It depends upon Conditions. So it is conditional. It is conditional because if the conditions are met, then I'll make a payment, otherwise not. So you can say the similarity is it's paid at a future date. And the difference is it is a confirmed payment, but it depends upon certain ifs and buts. And that's the reason I'm taking them together. So when you read the question and you evaluate that, okay, the payment is made in the future for sure, it is DC. And if you say that the payments are made, which is dependent upon the conditions met in the future, then it is CC. But then we also need to decide CCE and CCS. So let's, I think, give you a three-step model to make life simple. In order to decide whether it is a DC or it is a CC, let's, I think, give you a three-step model to decide. Now, there is something more which is also coming in my mind, and I will also discuss that very shortly with you. I'll give you that inputs very shortly, but first let's concentrate on the three-step model. So we're going to apply step number 1, step number 2, and step number 3. How will I decide that it is a case of DC or a case of CCS or a case of CCE? Step number 1. You'll put a question, is the payment to be made in the future? So your question in step number 1 would be, I'm going to put a question. Is the payment going to be made? Is the payment going to be made in future? So the first question I'm going to put across is that, is the payment going to be made in the future? If your answer is a yes, you'll go to step number 2. If the answer is a no, then it's neither DC nor CC. Then it's neither DC nor CC, because if the payment is not to be given in the future, it's not deferred, it's not contingent. So you need to first of all see that the payment is going to be made at a future date. Next, once you decide it is made at a future date, now I will decide, are there any conditions? The second question which I'm going to put across is, are there any conditions attached? Are there any conditions attached? So are we saying that the money to be given is based on certain conditions or not? So if you say, no, there are no conditions, then we know it is DC. But if you say, yes, there are conditions, it is CC, and you'll go to step 3. Then you will go to step 3. I hope you got the inputs very clear. So I'll say, is the payment made in the future? Yes. It can be a DC or a CC. You go to step 2. Then in step 2, you see that are there any conditions attached? If you say there are no conditions, it is DC. If you say that there are conditions attached, then it is contingent consideration, and you go to the step number 3 and put another question. Now, in terms of the step number 3, I'm going to now put a questions that we will see what is that condition. Are you telling, because let me also tell you one thing at this stage. When you pay a contingent consideration, now one thing which you need to keep in background, the acquirer company approaches the shareholders of the acquiree company. Please hear this carefully. The acquirer company approaches the shareholders of the acquiree company to acquire the shares. Now, these shareholders of the acquiree are also employees of the acquiree. So what you need to keep in mind is that A Limited as an acquirer approaches the shareholders of B Limited. Now, these shareholders of B are also employees of B. So in this case, we need to see that when there is a condition, the acquirer company tells them that you need to be in service for a future period of time. Only then I'll give you a payment. So if the conditions attached is a future service, then it is given in the capacity of the employee. But if the conditions are anything other than a future service, then it is given in the capacity of the shareholder. So in this case, I'm going to put a question that, is future service required? So the main thing is that we need to see that, is future service required? Are we asking the shareholders who are also employees of the acquiree? Mind you, We're looking at the shareholders of the equity who are also employees of the company. We are saying, is future services required? If you say yes, future services are required, then it is a contingent consideration in the capacity of the employee. And if you say no, it's not a condition of service, then it is given in the shareholder's capacity. Now, another important thing which you need to keep in mind, that if you say it is a DC, then it is a part of PC. If it is DC, then you will take it as a part of the PC. The deferred consideration will be included in the purchase consideration, and this will be at fair value. Now, what is the fair value? It is the present value of future payments. It is the present value of the future payment. So whatever amount I've agreed to pay in the future, I will take a present value of that future payment and include it in my purchase consideration. Next, when I'm looking at CCE, this is not a part of PC. This is not a part of purchase consideration, because this is a payment which is given for future services. It's not given to the shareholders in the capacity of the shareholder. It's given in the capacity of the employee. I say, you work for me, I'll give you this payment. Then I'm not giving them in the capacity of the shareholder. It's not a part of PC. But if you say that it is CCS, it is again a part of PC. It's again a part of the purchase consideration, and that would be at the fair value. By the way, if you remember, when we did financial instruments, I told you that a contingent consideration is supposed to be a financial liability which is measured at a fair value. And I also told you that when I come to the business combination standard, I will remind you this. Remember that this is supposed to be, measured at a fair value initially at FPTPL. So in this case, this is the amount which is measured initially at a fair value. Now, let me just connect the dots again and then tell you what is the next agenda in terms of things. So what we are discussing, friends, is the concept of purchase consideration, where we said that there are 7 issues connected with the PC. And we are focusing on 3 parameters issues right now. Deferred consideration, something which is paid in the future, but it's confirmed. Contingent consideration in the capacity of the shareholder or in the capacity of the employee, something which is paid in the future, but is dependent upon certain conditions, ifs and buts. So in this particular case, when you look at a CCE or a CCS, they're future payments, but dependent upon conditions. And therefore, I give you the connect that you're going to put across a 3-step model. First, you're going to put a question. Is the payment going to be made at a future date? So if you say the payment is made at a future date, it can be a DC or a CC. If not, it's neither. If you say the payments are made in the future, you go to the step number 2 and see what type of conditions are attached. If the conditions attached is, if there is no conditions attached, then it is DC. No conditions, confirmed payment to be made in the future. No condition means DC. Taken as a part of the purchase consideration at a fair value, which is equal to the present value of the future payments. But if you say there are conditions, it is contingent consideration, but we need to decide, is it in the employee or is it in the shareholder's capacity? Then I'm going to put across a question that is there any, the condition, is that condition related to future services? Because as I said, when you're going to give a payment to the shareholders of the equity, the shareholders of the equity are also employees of that company. I tell them, I give you a payment if you work for me. So you require them a service. If you require them a service, it is in the capacity of employee, not a part of PC. But if you give them, any other condition, any targets other than a service condition, it is in the capacity of the shareholder. It's a part of PC taken at a fair value. I hope, friends, I stand clear on my thoughts on DC, CCE, as well as CCS. Then let me add something more at this stage. There is something more technical coming in. Okay, that's great. Superb, wonderful indeed. So CCE also to employees, but in the capacity of the shareholders. CCE is capacity of employees, but also the shareholders. I didn't get that. You mean to say that I give them two payments. One is in the capacity of employee and another payment in the capacity of shareholder. Possible? Then I'll consider the payment in the capacity of shareholders as a part of the PC and ignore the payment which is given in the capacity of employees. Okay, now I think let me also create something more. There's another question, sir. Unable to comprehend why not? Why CC is covered but not CCE? It's just salary. Okay. Let me now ask you something. If you're telling the person that I give you a payment and you work for me for a certain n number of years, is that a share-based payment? Should it be accounted under Ind AS 102 or should it be considered as a part of Ind AS 103? I think I'll get you an answer. Because if you're telling the other person that you work for me, then I give you a payment, then it's not a part of the acquisition deal. It's more like a share-based payment which you're giving to them. So then why Ind AS 103 would apply? You know, if you remember, even in terms of accounting standard 14, purchase consideration is what is given to the shareholder. So if I'm acquiring the shares from somebody else and I give them any payment for the acquisition of shares, it's a part of 103 accounting. But if you're going to give them a payment which is not in the capacity of shareholder, you say you may be a shareholder, but you're also the employee of that company. I'll give you a payment if you work for me. Then you're not giving that payment to buy the business. You're not giving a payment to buy the shares from him. You're giving a payment in, telling him that you work for me, I'll give you the perquisite value. It's more like Ind AS 102. Correct? Wonderful indeed. Now, friends, there is another issue which you need to be clear on. I don't know whether I should complicate this at this stage or not, because we need to get this in any case, either now or later. So you want me to discuss this now or later? Your choice. Tell me. There is something, which is going to be connected to this issue. So you want me to discuss now? Okay. So I guess we get the inputs in this case. Yes, sir. Now, okay. Let's, I think, discuss that. Now, please hear this very carefully. I'm just, creating some inputs at the back of your mind. At the end of the day, all these steps are being done for the purpose of step number 7. All these things are being done from the point of view 7. So I'll first give you a chain of thought. Please hear me carefully. I'm first giving you a thought process. Let's first give you a thought process to think. And on that basis, I'm going to work upon my inputs. So I'm looking at the step number 4 and the step number 7. I'm looking at the step number 4, which is the purchase consideration. And I'm looking at the step number 7, which is the journal entry, for acquisition accounting. Now, please hear this very carefully. In step number 7, I gave you a single entry, net assets, PC, NCI, balancing figure goodwill. Now, let me tell you one thing. I will divide my step number 7 in terms of 3 sub-steps. Oh my God. Now you'll say, sir, every time you come with 3 numbers, DC, CC, ECCS, 3 numbers. Now step number 7 divided in 3 numbers. We will look at 3 entries. One is pre-business combination. One is post-business combination. And one is on the date of acquisition. When I'm going to look at the journal entries in step number 7, I'm going to look at the journal entries in 3 parts. One is pre-business combination, one is post-business combination, and one is acquisition date. When I say pre-business combination, before the acquisition date. Post-business combination means after the acquisition date. So I am looking at 3 entries in terms of step number 7. Now, when I look at the purchase consideration, for example, for the time being, we looked at a deferred consideration, we looked at a contingent consideration, in the capacity of employee, or we looked at the contingent consideration in the capacity of the shareholder. Now, please hear this very carefully. Now, in this particular case, we decided that DC is going to be captured at a fair value, and this is equal to the present value of the future cash outflow. Remember, I said this earlier as well, in terms of financial instruments as well. Let me put this once again to you. And I said that's a golden rule in terms of Ind AS. In terms of DC, when you took the present value, what did you do? Discounting. And if you remember, I said in terms of Ind AS, whenever you do discounting, you do something in the future. And what is that? What you do in the future? Compounding. And that's called unwinding of discount. So which means today, when you consider the present value of the future payments, you've done discounting. Now, what am I supposed to do? I am supposed to do unwinding, or you can say compounding. So I also need to be clear that today what you have done, when you took the fair value, you have done the discounting. You have done the discounting at this stage. So when you record this out here, in this journal entry, you've taken the present value of the future payment. Can I say here you will do unwinding of discount? Is my thoughts correct? So you're going to do unwinding of discount, and the journal entry for the unwinding of discount as well. And in terms of unwinding of discount, I'm going to put the entry finance charge gets a debit and the DC gets a credit. All these concepts is going to be useful in terms of consolidation, Ind AS 110 as well. So even in terms of Ind AS 110, I remember there is a question which came in the exams, and in that particular case, there was an omission of a DC entry. And 2 years had already passed by and the entry stands omitted. So you also need to be clear that this present value will lead to unwinding of discount in the future. How the entries are done, we'll see all that. But you just need to keep in mind, today in step 3, when you take the present value, the discounting concept, tomorrow in step number 7, after the acquisition date, it'll lead to unwinding of discount as well. Next. As far as CCE is concerned, it's not a part of the purchase consideration. But when it comes to CCS, you are taking it as a part of the consideration at a fair value. At a fair value. Now, please hear me carefully, because I will discuss this further in detail with you and do some questions also with you on this area. When you say it is a contingent consideration, in this particular case, what is important to see is that what is the form of payment? What is the form of payment? The form of payment can be either it is given in the form of cash or it is given in the form of shares. Either it is given in the form of cash or it is given in the form of shares. And if it is given in the form of shares, it can be either fixed number of shares or it can be a variable number of shares. Now you know where my thought is going. So when you say it is a contingent consideration, the payment is either in cash or the payment is given in terms of shares, and that is either a fixed shares or a variable number of shares. If the payment is given in cash, it becomes a financial liability. And if the payment is in fixed number of shares, it becomes an equity instrument by virtue of Ind AS 32. So that means you need to apply Ind AS 32 and then decide that is this contingent consideration supposed to be a financial liability or is it an equity instrument? And if it is variable, then also it is a financial liability. If it is a financial liability, subsequent measurement will be done as per FPTPL. That means any fair value changes will be captured in the P&L. And if it is supposed to be equity instrument, then no further changes are captured. Sir, once again. So can you put that once again? I know a lot of information coming in. So let me put this once again to you. I am now trying to match the thought process that when you calculate a purchase consideration, you also need to be careful and you need to be clear that because of this, what is the impact in the seventh step that is after the acquisition entry? Will there be any accounting implications happening later? So the moment I say that there is a consideration component, a PC component, I need to be clear that, okay, is this also going to lead to some subsequent accountings post the acquisition date? So what I try to map in your mind is that if you've got a deferred consideration and you've taken a present value, then remember that after the acquisition date, unwinding of discount, finance charge will be attributed. When you consider that it is a CCE, it's not a part of PC. Therefore, I'm not concerned. But, let me tell you that even though I'm not concerned, can I say it'll lead to the application of Ind AS 102 for sure? It'll lead to an application of Ind AS 102 for sure, because this is a share-based payments. Because you're giving them in the capacity of the employees, so Ind AS 102 will separately apply in the books of the acquirer. And when it is in the capacity of the shareholder, then we will initially measure it at fair value. Then you need to see the form of payment. And you need to see that if it is in cash or it is variable shares, it's a financial liability to be subsequently measured at FPTPL. And if it is supposed to be in terms of fixed number of share, it's an equity instrument, and therefore no remeasurements will be required at a later stage. Because equity instruments issued is just like equity shares issued, no subsequent accounting is done. But if it's a financial liability, it will be captured at a fair value, and any changes in the fair value, increase or decrease, will be put in the P&L. Am I clear, friends, on my thoughts? I hope I stand clear on my thoughts in this case. We'll do questions on this area, don't worry. And that's right, I think I got the correct inputs followed by compounding. That's wonderful. Was super. Okay, so let's come back on the inputs out here. So we have covered the three issues related to the concept of a purchase consideration. And we've also got connected in terms of how the subsequent accounting will take place. Now, let's, I think, do some questions with you. There are some questions in the study material which is dealing with the concept of DC, CCE, and CCS. Let's go to the study material on the illustrations. Yes, there is now an interesting question coming in. Illustration number 25 in the study material. So I'm taking you to the illustration number 25 in the study mat. So this continues on the next page, and this one also, I'll just crop it a bit. So illustration number 25, illustration number 26, 25 and 26. And there is just a last liner out here. So I'll just probably expand this. Okay, let's come to the illustration number 25 to begin with. Let's see the insights. We'll apply this concept. Whatever learnings are there, we'll apply this particular concept out here. Let's have a look at illustration number 25. It says KKV acquires 100% interest in Viva, a company which is owned by a single shareholder who is also the KMP of the company. Who is also the KMP of the company. Did you understand this? That he is the shareholder of the company. He is also the employee of the company. So the person who is the shareholder of the acquiree is also the KMP, the employee of that company. Now, I need to say that when I approach him as an acquirer, is the payment given to him in the capacity of the employee or in the capacity of the shareholder? So remember the three-step model which I gave you. It says for a cash payment of $20 million and a contingent payment, which is $2 million. So this cash payment is given right now. And then it says a contingent payment of $2 million. The terms of the agreement provide for a contingent payment 2 years after if the following conditions are met. Quick question, is it DC or is it CC? It very clearly tells you it's a contingent payment if the following conditions are met. DC or a CC? Undoubtedly CC. Undoubtedly CC. Then he says, what are the conditions? The EBITDA margins of the company 2 years later is 21%. Now, am I asking him to serve my company? No. I'm not asking to serve my company. So what do you think? It is CCE or a CCS? The payment is in the future? Yes. And in this case, it is dependent upon conditions. Yes, the condition is not a future service, but it is meeting some EBITDA margins. So that's right. It is CCS. It says the former shareholder continues to be employed. Now see, he adds on, the former shareholder continues to be employed for at least 2 years after acquisition. Aha. I gave him a target to achieve and then told him that you need to serve my company till you meet the target. So can I say in this case, do you think it is CCS or a CCE? Because initially when I looked at the target, it seems it is CCS. But then similarly, immediately later he says that you need to serve my company for the next 2 years to meet this target. So it is more like, a service condition with a performance. So it becomes a performance condition as per Ind AS 102. So it says no part of the contingent payment will be paid if the shareholder does not complete 2 years of payment. So determine the purchase consideration. Now we can clearly say that this is a case of a CCE. So nothing will be taken as a part of the purchase consideration. This will be a payment by virtue of Ind AS 102. In the above scenario, the former shareholder is required to continue in employment and the contingent consideration is forfeited if the employment is terminated or he resigns. Accordingly, only 20 million, that payment in cash, is a part of the purchase consideration and the contingent consideration is accounted as an employee cost as per other Ind AS. That other Ind AS in this case is Ind AS 102, share-based payments. So this is a payment which is given in the capacity of the employees. So the cash consideration which you gave them 20 million is a part of the PC, but 2 million is not a part of PC. That is going to be a part of Ind AS 102 accounting. Great. Let's see illustration number 26. It says ABC acquires all the shares of company XYZ in a business combination. XYZ has got 3 shareholders with equal shareholdings. 2 of them are also senior level employees of XYZ and would continue as employee post acquisition. So out of 3 people, 2 people are also shareholder. So there are 3, you can say, shareholders. 2 of them are shareholders and the employees of the acquiree, and 1 is only the shareholder of the acquiree. Now, when I approach them, I need to see that the payment I'm giving them is in which capacity. It says the employee shareholders each will receive 60 lakhs plus an additional payment ranging from 150 to 200 lakhs based on the multiple of earnings over the next 2 years. And the non-employee shareholder will receive 100 lakhs. Now, there are 2 different set of payments. The person who is the employee shareholder is going to get 60 lakhs today, and he will get an additional payment which is in a range based on the multiples of earning. And the non-employee is going to get 1 lakh, 100 lakhs today. The additional payments of each of these employees will be forfeited if they leave the employment at any time during 2 years following the acquisition. Now let's ask you the question again. Is this payment paid in the future? Yes. Is this payment dependent upon the conditions to be met? Yes. And you tell me, am I requiring them a service? Am I telling them that you need to be in a service for the next 2 years? Otherwise, I'm not going to give this payment. CCE or a CCS? Is this paid in the capacity of the employee or is this paid in the capacity of the shareholder? And that's rightly said. It is paid in the capacity of the employee. That's right. Sir, it's not visible. I think, oh, okay, because I wanted to show some answers as well. Nobody, we can, I think, zoom this a bit further as well. But, let me just, I think, give you the quick inputs. Sometimes it's the size doesn't fit into the board because the page is a little bigger. So please bear with me on that. So in this particular case, I guess if I just give you the answer, it is supposed to be a CCE. It is supposed to be a CCE. So this 60 lakhs will definitely be a part of PC, but this range of money is not a part of PC. And what is paid to the non-employees, of course, is a part of the PC as well. So it says the additional consideration of 150, 200 lakhs represents a compensation for post-business combination, and that part of payment is forfeited if he does not remain in service. So it says only that 60 lakhs is attributed to consideration in exchange for the acquired business. So basically, the inputs were very clear. You need to put a 3-step model to decide that, whether it's a part of the purchase consideration. So let's put it in short. If there is a payment in the future and it's a confirmed payment, it's a DC, take the fair value, that is the present value as a part of the PC. If there is a payment in the future which is dependent upon conditions but they're not service conditions, then it is CCS taken as a part of PC at a fair value. And if you say that it is supposed to be a case of a future payment, but there is employment conditions attached, it is CCE. It's not a part of PC. It's a share-based payment, and therefore Ind AS 102 will apply. This is on the date of acquisition. Now, what is the subsequent accounting? You've seen the connect as well. If it is DC, unwinding. If it is CCE, not concerned. Only 102 will apply. If it is CCS, depends upon the form of payment. If the form of payment is supposed to be in terms of cash or variable shares, it's a financial liability remeasured at a fair value. And if it is supposed to be a case of a fixed number of shares, it's an equity instruments with no remeasurements. Now, you must be thinking, is there any question which pertains to the post-business combination accounting as well? Yes. Shall we do that question as well? Yes. But I think first we should give you a break on that. Yes. And then start the journey in terms of looking at one question where we look at the subsequent accounting as well. I think that question is there in the study, I guess. Otherwise, I'm also carrying that question. Nobody. I think I have a question of my own as well, which I'm carrying. So we'll do that particular question also. It's a wonderful question, which will, bring us to that bring us to the DCCC concept very clear. Then we'll go to the more issues pertaining to this. Right, friends. So I think time to give you some break at this stage. Let's take a 10-12 minutes rest and then we commence back again. So please take a rest on your minds and just spend maybe a minute later just to, revive the concept, just go through this inputs, what we have covered, so we stand very clear. Let's take a break. We'll meet you after the break, friends. Okay. I hope you had a relaxation of mind and at the same time, just I think went through the basic concepts. I think now we are ready to go to a little more comprehensive question, which is on the contingent consideration, of course. And we're going to see that, whether the classification happens like a financial liability or equity share. So we can also decide the subsequent accounting as well. So not only deciding that whether it is a part of the purchase consideration or not, but also connecting how would the subsequent accounting happen. So I have just taken one particular question from my own side. Let me share that question to you. Right. So this is an RTP November 22 RTP question. It's there in the educational material as well. So let me just zoom it across to you. I hope this is clearly visible to you. I think so. Let me know if this is visible. Otherwise, I'll just crop up the question number. I think it should work good now. Yes, perfect. So let's, I think, read the inputs which are given in the question. It says, how should a contingent consideration payable in relation to a business combination be accounted on initial recognition and on subsequent measurement? So the focus is on step number 3, step number 4, as well as on step number 7. Because when I say initial, the focus is the PC, step number 4. And when I say subsequent, the focus is on step number 7. Now, there are two parts to the question. Part number A, it says on 1st April 16, A acquired 100% interest in B. As per the terms of the agreement, the purchase consideration is payable in the following 2 tranches. It says there is an immediate issuance. Immediate issuance means it cannot be a DC, it cannot be a CC. This is what is immediately issued. It says a total of 10 lakh shares with a face value of 10 rupees per share. And then it says there is a further issuance, and that is 2 lakh shares after 1 year. So it's at a later date. It says if the profits of before interest and tax for the first year following the acquisition exceeds 1 crore. So let me, I think, put the questions to myself on a 3-step. Number 1. Is the payment paid in the future? Yes. Are there conditions attached? Yes. Is the condition related to future service? No. So would you like to tell me CCE or a CCS? Because the conditions are nowhere attached in terms of any service condition. So is it going to be CCE or a CCS?
Yes.
That's absolutely correct. Then he says the fair value of the shares of A on the date of acquisition is 20 rupees per share. So we given the fair value of the shares is 20 rupees per share. Further, the management estimated on the date of acquisition, the fair value of the contingent consideration is 25 lakhs. During the year ended March 17, the profit before interest and tax exceeded 1 crore. And then it says on 31st March, the fair value of the share has become 25 per share. Okay, now let's, I think, first of all, understand the part A. We'll get the answer, then we go to the part number B. So the focus is in terms of 2 things. One is the focus in terms of initial accounting. And we know it is a case of a CCS. So we definitely go to consider the fair value of this contingent consideration. So we given that a further issuance of 2 lakh shares will be given. And we're very clearly given the fair value of this contingent consideration is 25 lakhs. Let me also calculate my purchase consideration. Can I say the purchase consideration is issue of 10 lakh shares? And I think I already gave you earlier that when you consider the PC, and the PC is in shares, you need to take the fair value of the shares issued. And the fair value of the shares issued is 20 rupees per share, and plus the contingent consideration that I think works out at 225 lakhs. That is the purchase consideration. So initial part is done. Now let's come to the subsequent accounting as well. And for the subsequent accounting, you need to first of all decide that is this contingent consideration a financial liability or is it an equity instrument? We told the shareholders of the acquiree that we're going to give you 2 lakh share. So can I say if you're giving 2 lakh shares, it is supposed to be a fixed number of equity shares? And if it is a fixed number of equity shares, it would become an equity instrument. So it becomes an equity instrument. Can I say there will be no remeasurements which will take place? Because it is an equity instrument, so there is going to be no remeasurements which will take place in this case. Done. So I think the initial and the subsequent measurement is done. Now let's go to the part number B. Now let's have a look in terms of the inputs which are given in the part number B. It says, continuing with the pattern in A above, except number of shares to be issued after 1 year is not fixed. If it is not fixed, that means it is variable in nature. Rather, A agreed to issue a variable number of shares with a fair value equal to 40 lakhs after 1 year if the profits before interest for the first year exceeds 1 crore. So I think the initial accounting, of course, for the part number B would remain the same. But I think for the subsequent accounting, now what we do classify this as. Let me put this part number B out here. So we can say the initial accounting is same as A. So initial accounting is same as the part number A. Now let's go to the subsequent accounting. So in this particular case, if you're giving a variable number of shares, it becomes a financial liability. And if it is a financial liability, can I say a remeasurement will be done? Is this financial liability at FPTPL? Yes. The fair value of this liability at the end of the year is 40 lakh. So can I say from 25 lakhs, the fair value increases to 40 lakhs. So can I say this will be debited in the profit and loss? This is a loss of 15 lakhs. And that 15 lakhs will be taken in the P&L because we will capture this liability at FPTPL. I hope, friends, I stand absolutely clear on the agenda. I think I am hopefully absolutely clear on the agenda. And that's rightly given. Wonderful indeed. Okay, so this takes care of the 3 issues relating to the PC, DC, CCE, CCS. You know what? When you sit down and make your own mind maps, you should be very crystal clear and your mind should start working in terms of initial accounting, what is the role, in terms of subsequent accounting, what is the role, and if you're able to get the dots connected, super. What I'll do, when I come to the step number 7, I will again give you a comparative chart. Whatever entries are there based on the first 6 steps, whatever concepts comes out of the first 6 steps, I'll divide those in step number 7 in 3 parts: pre-business combination, acquisition date, and the post-business combination. Will pen down a wonderful chart which will give us all the dots connected. Okay. So that is the reason, though I think based on the scheduling, there are 4 sessions on Ind AS 103, but I'm going to spend 1 extra because I'm taking some overlapping concepts in terms of 110. So today is supposed to be the 3rd class. I'm going to spend another 2 sessions on Ind AS 103 before I go to Ind AS 110. Because there are a lot of other concepts connected to Ind AS 110 which I want to get it covered here itself, because this will give us a good broader view. When I come to Ind AS 110, then there are more issues coming in, and therefore we'll try to cover some issues here. Okay, so this is done. Now let me go back.
Sir, I have a doubt.
Sorry.
Sir, I have a doubt. Further
Yeah.
issuance of 2 lakh shares is not a part of BC?
Further issuance of 2 lakh shares, no, it's a part of PC. In any case, whether you are issuing fixed shares or variable shares, it is a CCS. So it's a part of PC. The only thing is that if it is fixed shares, then on the balance sheet date, no remeasurements will take place. But if it is a variable shares, the remeasurement will take place. But both are part of PC.
बट सर आपने उसमें कंसीडर नहीं किया है पीसी में.
किया बेटा मैंने. लेट मी शो इट अगेन. Initial I said no, same as A. So that means 225 is here. So even if it is part B, it remains the same as A, 225. The only difference is that this is not remeasured later. But in this case, I said you remeasure it from 25 to 40. So PL will get a debit of 15 lakhs.
No, sir. PC is equal to 10 lakh shares into 20 rupees fair value.
Correct.
Further issue 2 lakh shares is not considered. No?
No. You see, it's given out here. The management estimated the fair value of the contingent consideration is 25 lakhs. So the 2 lakh shares which you're issuing, you need to get the fair value of that CC. So that 2 lakh shares which will be issued has been fair valued at 25 lakhs. So that 25 lakhs which you have taken is nothing but the fair value of the CC.
Okay,
you got my point?
Okay. Got it.
Because when you take the CC, you're not supposed to take the fair value of the shares. No. Because whether the consideration will be payable or not, all that has to be assessed. So when you take the fair value of that CC, it incorporates the probability whether it will be paid or not. So that 25 lakhs is the fair value of those 2 lakh shares which will be issued at a future date. Correct. Okay, now let's go back, and I am now coming to the next issue which I gave you in PC, the list of my 7 issues. And let me just come back on those 7 issues with you. I had given a chart on the 7 issues. Let me just come back on the chart. Where is the chart gone? Yes, here it is. Okay, so I think now if I just put a tick, we're done with DC, we're done with CCS, we're done with CCE. For TC, I think let me just point blank give you something. Not a part of PC, done. I think I gave you that earlier as well when we were making a distinction between the 2 kinds of accounting, asset accounting and acquisition accounting. I said if there is any kind of TC brokerage commission, when you buy an asset, it gets added to the cost of the asset. But when it becomes a case of a business combination, then it's not a part of PC. So TC is not a part of PC. TC is not a part of PC. This is expensed to P&L. It is expensed off. So this will be charged to the profit and loss there and then. That's it. Okay, now we are going to discuss the concept of PHI, previously held interest. Now this is going to be complicated. These 3 agendas will now take time: PHI, SBP, and pre-existing. Let's begin a journey in terms of PHI. Let me add the PHI here itself. Okay, now let's go to the 4th issue on the PC, rather the 5th issue, and I'm considering the concept of PHI. That's called previously held interest. That's called previously held interest. Now, this is also a bit complicated, so please hear me very carefully, because some portion of this we'll discuss when we come to the consolidation standard. But let me, I think, first give you a little mapping in terms of this area. Now, please hear this very carefully. I know it's a little complicated, but we'll go slow and we'll understand the concept in this case. Okay, I'm getting a question also. So which means after 1 year, 40 lakhs will be paid instead of 25 lakhs when it is variable. That's right. Because your discharge of the consideration is going to be costing the company a total of 40 lakhs. That's right. Okay, now let's come to the concept of a PHI. Now watch this carefully. When I say previously held interest, we're looking at that control is acquired in stages. Please mind the words what I'm saying. When I say a PHI, the PHI means that you have acquired the stake in stages. So this is also called step acquisition. This is also called step acquisition because you acquired the shares in stages. You acquired some shares, then acquired more shares, and then you got a control. So there can be two situations which will get covered out here. Situation number one, you were a passive investor. Situation number two, you were a passive investor and then you achieved a control. Situation number two, you had a significant influence. You had a significant influence and then you acquired more shares and you got a control. So when I look at a step acquisition, there are two broad cases I'm looking at. One is that you were a passive investor and you got a control, or the other one is that you had a significant influence and you got a control. In terms of percentages, broadly, when you say you're a passive investor, you've got below 20. Because when you get 20 or more than 20, but up to 50, you get a significant influence. So when I say that you're a passive investor, that means you had a stake which is below 20%. And then you acquired more shares to get a control. If it is significant influence, it is 20% or more, but you can say below or you can say up to 50%. You can say up to 50%, then you get a significant influence. And then you acquired more shares to get a control. So this is called step acquisition in nature. Now, what we need to do, we need to be very clear on our thoughts that if it is a conversion from a passive investment to a control or a significant influence to control, then what do we do? Now, in this case, again, my focus is in terms of step number 4 and step number 7. Mind you, you need to be very clear in terms of step number 4 and step 7 that is there going to be any impact in terms of my journal entries as well. So what I'm going to do, I'm going to give you the impact of this accounting. I'm going to give you the impact of this accounting in terms of two stages. One is the impact in terms of step number 4, and one is the impact in terms of step number 7. That is when you put the entries in the books of accounts, then what is the impact? Now watch this carefully. We'll do questions on this as well. When you say it is a case of passive investment to control, in the purchase consideration, we will take the PHI at a fair value. Even if it is a second case as a part of the PC, we will take the PHI at a fair value. So which means irrespective, it is a case 1 or a case 2, situation 1 or 2, the previously held interest is to be remeasured. And the fair value of the PHI is a part of the purchase consideration. So the basic input is that you need to go in for a remeasurement. You need to go in for a remeasurement of the PHI. The PHI will be remeasured and it will be taken at a fair value as a part of the PC. Now, there are some accounting entries to be done. Because when you say that I'm going to remeasure it at a fair value and take it as a part of the PC, now some journal entries need to be done. Now, these entries will be done in the pre-business combination, not on the date of acquisition. Not on the date of acquisition. The impact of this is going to be pre-business combination. Before passing the acquisition entry, I'll have to take care of these inputs. Now, let's, I think, first of all, understand one thing. If you were a passive investor, can I say you were doing the accounting under Ind AS 109? If you were a passive investor, you were doing the accounting under Ind AS 109. It was equity investments under Ind AS 109. Which might have been measured at FPTPL or it might have been measured at FPT OCI NR. You've already seen in financial instruments that unrelated party equity investments are accounted under Ind AS 109. So which means in this particular case, we can say that either the investment is measured at FPTPL or it is measured at FPT OCI. There is no recycling or no reclassification. If it is measured at FPTPL, naturally when you took the PHI at a fair value, so you would have got a gain or a loss on revaluation. When you did the remeasurement, you would get a gain or loss as well. Any gain or loss in terms of book value and fair value will be taken in the profit and loss. And in the second case, if it is measured at OCI, any gain or loss in this case will be taken in the other comprehensive income. So when you're going to remeasure the initial investment, when you're going to remeasure the previously held interest, any gain or loss, that is the book value of the investment vis-a-vis the fair value on the acquisition date, you will get the gain or loss in the P&L or the OCI. And in this case, there will also be an accumulated balance in tab 3, right? So there will also be an accumulated balance in tab number 3. Any wild guess? Where will you take that accumulated balance? Now you're out of Ind AS 109 financial instruments and you've entered the control. So can I say that standard will not apply now? So what do you think what will I do with the accumulated balance in tab number 3? Any inputs on that? So what am I going to do with this? And that's right. Yes. Sorry, missed your answer, beta.
Scrutinize, sir.
Yes, move to tab number 2. So can I say I will take it to the tab number 2 and put it in the retained earnings? I'm going to put this in the retained earnings. So in this particular case, whatever money is there in terms of the tab number 3 will be shifted to the tab number 2, that is retained earnings. That's one. Next. Now let's come to the other case. The other case we're looking at is that it is a case of a significant influence to a case of control. Now, since it was a case of significant influence, you would have been covered under Ind AS 28. So in this particular case, you would have accounted under Ind AS 28, and this is using what we technically call an equity method of consolidation. Though we are yet to do the Ind AS 28, we have not done Ind AS 28, that will come later, but this investment would have been accounted under Ind AS 28. Now, let me tell you, if there is a difference in the book value and the fair value of this equity accounted investment, this is going to be taken in the profit and loss. And let me also tell you, though I think it's a little early, so we'll not cover it out in Ind AS 103. But due to the application of Ind AS 28 also, there can be an accumulated balance in OCI. I'm saying due to the application of this Ind AS 28 as well, there will be an accumulated balance in tab number 3. But we'll deal with that in Ind AS 110 later, not at this stage. But I'd just like to make a mention that in this case, there will also be an accumulated balance in the tab number 3 in terms of OCI. But how do you tackle this? We will discuss in 110. We will discuss this when I come to the consolidation standards and 28, because it's dangerous to explain you at this stage. But I just want to keep something at the back of the mind, that you know that in this particular case also there will be some accumulated balance due to the application of equity method. What do you do with that particular balance? We'll see later. Let me just connect the dots once again. So we are looking at the concept of a PHI, a previously held interest. You need to carefully look at the language of the question and see, is it a conversion of a passive investment into a control, or is it a conversion of a significant influence into a control? If it is a case of a conversion of a passive investment to control or a case of significant influence to control, one thing is simple. In terms of the step number 4, you will remeasure the PC, you will remeasure the PHI, take it at a fair value. So in the purchase consideration, you will consider the fair value of the previously held interest. And this will lead to gains or losses because of the book value and the fair value getting different. So in terms of step number 7, before passing the acquisition entry in a pre-business combination, what we are going to do? If it is the situation number 1 and you were a passive investor, either it was accounted at FPTPL or FPT-OCI. If it was FPTPL, the gain loss in the P&L. If it is FPT-OCI, the gain loss in the OCI. And There would be some accumulated balance in the OCI in tab 3, and that will be transferred to the retained earnings directly because this is OCI NR. And if it is a case of the second situation where you were accounted under Ind AS 28, then you would have applied equity method of accounting. Any fair value gain or loss will go to the P&L. But due to the equity method, there will be some accumulated balance in tab 3 as well. How do you tackle that balance in tab 3? That we'll see when we come to the consolidation standards. But there is something to be done with reference to that accumulated balance in tab 3 at that stage as well. Right, friends, I hope I am clear on my thoughts. We'll do some practical questions now on this area. Okay, sir, if there could be a transition from a passive investment to a significant influence, then we will transit from 109 to Ind AS 28. Yes. Which then you said which we learn in Ind AS 28, right? Yes. So you know what? I'll tell you. I think your mind is working absolutely great. It's like, there can be a lot of combinations. There are cases which can be step acquisitions, and there are cases which can be disposal of shares. So we'll be coming to Ind AS 110, where we'll look into permutations and combinations of step acquisitions and the case of further disposal. So the one which you said, conversion from 109 to 28, gets covered in 28. In fact, this area of step acquisitions and disposals can be attributed as a one complete level of discussions in life. One could consider them as a separate chapter altogether, where you would need to get into all the different permutation combinations which can come. Of course, we'll not get into that kind of details, but yes, I will definitely give you a lot of combinations therein. Some combinations we will do in Ind AS 110, some combinations we'll do in Ind AS 28, and just two combinations we're doing in Ind AS 103. So by the time 103, 110, and 28 gets completed, you get a flavor of all those permutation combinations, that what is the kind of accounting which is done. Correct. So mind is working good. That's great. Okay, so let me now, I think, take you to a practical illustration on this. So let's come to a little practical area on the calculations of the PC. I guess there is one question at the back in the test your knowledge. I'll first take you to that particular small little question on the test your knowledge, TYK. Right, so this is a small little question which is there. Let's, I think, come to this question with you. This is, I think, question number 5. Let me just zoom it across to you. This is question number 5 in the study material, which is given on the test your knowledge. I think that's good to go. Should be clearly visible, I believe. Right. Clearly visible, I guess. You can see the question clear?
Yes, sir.
Okay, that's perfect indeed. So now let me, I think, read out the question to you. We'll see which case is this. On 1st April X1, Company A acquired 5% of the equity share capital of B. So when I say it acquired 5%, so one thing is very clear, that A was a passive investor and Ind AS 109 would apply. Then he says A accounts for the investment at B at fair value through OCI under Ind AS 109 financial instruments. Then he says at the end of the year, on 31st March X2, A carried the investment in B at a fair value and reported an unrealized gain of 5,000 in OCI. So this is what is accumulated in the tab number 3. And it is presented as a separate component of equity, which means it is presented in the tab number 3. Then he says on 1st April X2, A obtains a control by acquiring the remaining 95% of B. Comment on the treatment to be done based on the facts which are given in the question. So I think to give you more power, to more clarity, I'm going to discuss the implications on step number 4 and step number 7, both of them. So let's, I think, look at the results in terms of both the steps. How would you tackle this in terms of step number 4? And how would you tackle this in terms of the step number 7? In terms of the step number 7, we are looking at the pre-business combination accounting. What will happen on the pre-business combination accounting? So first, can I say this PHI will be remeasured? So am I given the status of what is the fair value on 1st April X2? I don't think so. So we'll just make a mention that this will be remeasured. This will be remeasured and it'll be a part of PC at fair value. So we can only give it theoretically because I'm not given any facts in this case. Now, let's look at the accounting entries in this case. Can I say, first of all, you'll have to put the entry investment gets a debit and other comprehensive income gets a credit, or vice versa, depending upon it's a gain or depending it's a loss. So remeasurement of the investment will lead to a gain or loss, and that gain or loss will be taken in the other comprehensive income. And secondly, whatever is the accumulated balance in tab 3. Whatever is the accumulated balance in tab 3, in this case, the accumulated balance in tab 3 is 5,000. That's an unrealized gain. So can I say we will put the entry OCI gets a debit and retained earning gets a credit, and this is to the extent of 5,000. I hope I stand very clear in terms of the entries and the concept. So in terms of the step number 4, PC will include this at a fair value. That's one. Remeasurement gain or loss captured in the OCI, accumulated balance in tab 3 shifted to tab number 2, that is retained earnings. This is case 1. I've got another question from my side which is pertaining to the case number 2 as well. Let's go in the end. So I've just taken one question which is also an examination question as well. Yes, this is question number 12. This is question number 12, and this came in June 2019 exam. So this is June 2019. It came in the exams. Let me zoom it. It's also there in the education material. So not exactly this question came in June 19. But a similar question came, exactly a similar question came in June 2019. So you can try that as a practice, June 2019. This is the question which is there in the education material as well. Now, let's read this with you. And I think this question contains that part which I said discuss later in terms of 110. I think let's discuss it today only. Let's discuss it today. And okay, let's, I think, first read the inputs. On 1st April X1, P acquired 30% of the voting power. And that means you've got a significant influence. That means you're covered under Ind AS 28. It says for 8,000 crores, PQR accounts the investment using equity method as prescribed under Ind AS 28. So with a 30%, we've got a significant influence and Ind AS 28 is applied. Then he says at the end of the year on 31st March, PQR recognized its share in the net asset changes using equity method. Now, I think I'll have to give you at least some basic idea so we can understand and appreciate this question as well. I know we are not done with the concept of equity method, but let's give you some basic flavor so we can understand this issue. So I'm going to spend 5 minutes with you just to give you a quick insight on how does the equity method of accounting apply. So let me, I think, just come out of this question and just give you some basic application, some basic knowledge. Let's give you some basic knowledge on equity method of accounting. So I'm just giving you some basic knowledge on the equity method of accounting as per Ind AS 28, only to the extent I need it for the purpose of this standard. So let's give you some basic knowledge on this. You need to consider the concept of equity accounting like this. Let's say this is the investment I have in the associate. When you get a significant influence over a company, it becomes an associate. So let's say this is the investment, and let's say this is the net assets of the associate. Now, the thought process in Ind AS 28 was very simple. I'll be coming to this in detail when I come to Ind AS 28, but for the time being, let's give you some basic knowledge of the standard. So the standard setters said that we want to show the investment. We want to show the investment at share in the net assets. Their idea was that what we'll do, that the investment will be reflected in the financial statements at the share in the net assets. And for this purpose, they decided that if the net assets of the associate company goes up, I will increase the value of the investment to the extent of my share in that increase. If the net assets of the associate goes down, I will bring down the investment to reflect the share in the net assets. So basically, the standard Ind AS 28 requires the investor. It requires the investor, I would say, to track the changes in net assets, to track the changes in net assets of associate. It requires that you should track the changes in the net assets of the associate company. So I will simply track the changes in the net assets of the associate. So what will I do? If the net assets of the associate goes up, investment debit. If the net asset goes down, investment credit. The investment will move according to the net assets. Net asset goes up, investment debit, to the extent of share in that change. The net assets goes down, investment gets a credit to the extent of share in the decrease. But one thing is still there. When I say the net asset goes up, you say investment debit. When I say net asset goes down, investment gets a credit. But what about the corresponding credit or a debit? And so therefore the standard setters decided that if the net assets of the associate company goes up, what I'll do, I will debit the investment, increase it. And if the net asset goes down, I will credit the investment. So every time there is a change in the net assets of the associate, if they go up, investment debit, if they go down, investment credit. Now, where do I take the corresponding? Where do I take the corresponding credit or the debit? So the standard setters decided that the corresponding credit or debit is going to be a mirror accounting. They said that the corresponding credit or debit is going to be a mirror accounting. Now, what is that mirror accounting? Let's assume that the associate company revalues the asset. It would have given a credit to the OCI because of Ind AS 16. So I will also give a credit to OCI. So if the associate company gives a credit to the P&L, I will also give a credit to the P&L. If they give a credit to the OCI, I'll also give a credit to the OCI. So the entire accounting was that there are two aspects. One is you track the changes in the net assets and the investment gets a debit or credit. When the net asset goes up, investment debit. Net asset goes down, investment gets a credit. Second, we need to consider that the corresponding credits or debits will be a mirror accounting. When the net assets of the asset goes up, the credit goes to the P&L. He'll also credit the P&L. If the credit is gone to the OCI, he also credits the OCI. So due to the application of the equity method, what will happen? Every time the investor will put an entry, investment debit, either a P&L credit or an OCI credit. So OCI also gets a credit due to the application of the equity method. Did you get my point, friends? Did you understand the basic knowledge in terms of how Ind AS 28 is applied? Got the point? Then I think we can take this further. That's great. So let's now go on to the question back again. So now it tells me the inputs at this stage. It says that PQR recognized its share in the net asset changes. As I said, you need to track the changes in the net asset and incorporate this in the accounting. This is the share in the profit or loss. So can I say in this case, you would have done the entry, investment gets a debit and the profit and loss gets a credit. And if you look at the share of the exchange difference and the share of the revaluation, can I say in these cases, you would have done the inventory, entry, investment debit, and other comprehensive income gets a credit. So we can say on account of these two items, there will be an accumulated balance in tab number 3. There will be an accumulated balance in terms of tab number 3 because of these two entries. Now, watch me carefully. Once you decide that there is a balance in the tab number 3, now in terms of this case, that is a conversion of an associate to a control, you need to scrutinize. Because every time you're putting this money in OCI, it could either be R or it could be NR. Every time you're doing the equity method accounting and you're putting the money in other comprehensive income, it is either getting credited, accumulated in OCI R or OCI NR. So what you need to do, once the conversion of the associate to a control, to a subsidiary is done, you need to make a scrutiny of this OCI. So what I need to do in this particular case, I'll have to make a scrutiny of this OCI. So we will do a scrutiny. We will do a scrutiny of this other comprehensive income, and we will say the portion which is NR should be transferred to the retained earnings directly. Because whatever was taken in OCI NR will be shifted to the retained earnings directly, and whatever is taken to R is going to be shifted in terms of P&L. Wow. Which means now we have come to the conclusion, if it is passive to control, accumulated balance in OCI directly in retained earnings, no scrutiny. No scrutiny. But when you say that it is a case of an associate to a control, then in terms of the scrutiny of OCI, you need to see that is it OCI NR or is it OCI R. If it is OCI R, then I'm going to put that amount in the P&L. And if it is OCI NR, then I'm going to take it to the retained earning. The main thing is that in terms of 109, equity investments FPT OCI is NR only. So because if it is NR, scrutiny of that amount is not required. But in terms of equity method, the scrutiny is required to filter what is R and what is NR. And accordingly, that amount will enter in the RE or in terms of P&L. Oh my God. Sir, so many things to be remembered, but this is the value. If you're able to remember these things very well in the exams, trust me, it's not a difficult thing. Financial reporting, these standards typically requires a lot of efforts in terms of, accumulating things into your mind, just like a tab number 3. If you're able to, get the concepts clear and put it in the mind, document the notes, create the mind maps. That's why every time what I'm doing, I'm giving you mind maps in between so that this bigger kind of topic does not become a challenge for you. Once you're able to revise things, do the questions, get some more insights, incorporate them in your mind maps so that once you go through these particular things, you stand very, very crystal clear on that. Certain areas I know you might have to revisit as well, look at the videos again, which you can do that. Because that's a very good initiative, that you can actually go back to the videos and look at the portions which you feel is more important to you, which you feel you want to revisit as well. You can do that. Okay, so I think that is one part. Now let's come back to the question. So let me now also ask you, if there is a share of exchange difference in OCI, I guess it arises on account of Ind AS 21. And if it arises on account of Ind AS 21, would you like to tell me where will you take this amount? Where will you take this amount? Is it a case of R or is it a case of NR? This is a case of recycling. This is a case of reclassification. So that will be taken in terms of P&L. Then there is a revaluation reserve of PPE. This arises on account of Ind AS 16, and this is a case of NR. So this will be filtered in the retained earning. That is what the scrutiny is all about. You need to scrutinize the amount in the OCI and filter that is it R and R, and accordingly, I'll decide where is to be taken. Now, he tells me further, the investment was acquired at 8,000 crores. The carrying amount of the investment is, to this 8,000 crores, he added these figures. As we've done the entry, investment to P&L, investment to OCI. So this is the figure which is standing in the books of accounts. Then he says on 1st April X2, PQR acquired the remaining 70% for a cash consideration of 25,000 crores. And the following additional information is given. So we're given the fair value of the 30%, which is the PHI. And I'm also given the fair value of the net assets. How should a business combination be accounted for? Okay, I think we read the question now. Now I'll tell you how you should proceed in terms of this particular question. Now my input is, when you see a case where it is a conversion of an associate to a control, you should filter 3 entries in this case. I'll show you a proper solution on this now. So let's, I think, work upon a proper solution. So again, the focus is in terms of step number 2 and step number 4 and step number 7. So I would see the impact in terms of step number 4 in the purchase consideration. And I want to see the impact in terms of step number 7, that is the journal entry. Now, in this particular case, when I'm looking at the journal entry again, my focus is on the pre-business combination entry. My focus is again on the pre-business combination entry. You need to be clear in terms of the implication of this agenda, in terms of step number 4 and in terms of step 7. So, the first thing is that the PHI will be remeasured. The first is that the PHI is going to be remeasured, and I think in this time we are given the data. So we know the book value is 8850 crores and the fair value is 9,000 crores. So we know the book value in this case is 8850 crores and the fair value of this is 9,000 crores. Now what is important in this case is, you need to compare the book value in the consolidated financials vis-a-vis the fair value, because you are already accounting this under Ind AS 28. So you need to remeasure it by comparing the book value and the fair value. So this is going to be remeasured. So this is going to result in a gain. This is going to result in a gain of 150. But right now you just need to remeasure, and the only focus is that this 9,000 will be a part of PC. So in terms of the step number 4, the only crucial point is the PHI is going to be taken as a part of the purchase consideration at 9,000 crores. That's done. Now, the next input, what we need to understand is the entries pre-business combination. Now, my advice is do 2 separate entry. My advice is do 2 separate entries. Rather, let's do one more thing. Let's, I think, rather do one more thing. Let me split this in 2 parts. I want to see the entries in a pre-business combination, and I want to see the entries on the date of acquisition. Now, let's see what are the entries on a pre-business combination. I'm going to put 2 separate entries in this case. One is capture the gain in this case. The entry will be investment gets a debit and the gain goes in the P&L. So this is to the extent of 150 crores. So first thing what I've done, compared the book value and the fair value, and that gain 150 crores enters in the profit and loss. On account of equity method, any remeasurement gain goes in the P&L. You need to be clear. Passive to control is OCI or P&L, as the case may be. Significant influence to control is simply taken in the P&L. Then the second is you make a scrutiny. You make a scrutiny of the tab number 3 and put some entries. Now let's go back. So in this case, there is an exchange difference of 100 and there is a revaluation reserve of 50. So this 150 in the OCI. There's 150 in the OCI. something to be taken to RE and something is to be taken to the P&L. So once you do the scrutiny, you decide that out of this, what is the portion which is NR will go to the retained earnings, and what is the portion which is R will enter the P&L. So if I take this figure, then we can say 50 is the portion which is RE and 100 is the portion which is P&L. So this is the entry which is done. So this is the entry which is done in a pre-business combination setup. The investment is remeasured, the gain loss in the P&L, the OCI accumulated balance is scrutinized, and it is taken to RE or P&L as the case may be. Next. Now, when you look at the date of acquisition, in this case, we are doing the acquisition entry. Since I'm given the data in this question, let me do the acquisition entry in this case as well. So I'll capture the net assets and I'll take the purchase consideration, and I guess there is no NCI. So we're given the fair value of the net assets is 30,000. This is the fair value of the net assets. And if you take the purchase consideration, earlier you acquired a 30% stake whose fair value is supposed to be 9,000. And you've acquired another 70% stake paying another 25,000 crores. So we can say 25,000 crores paid for 70%. PHI is 9,000. So we can say this is the PC including the PHI. This is the PC including the PHI, that's 34. So we get a balancing figure in this case, and the balancing figure is goodwill. So we get a balancing figure, and that is goodwill. So I did not club everything in a single entry in this case. I divided my entries in 3 entries. I said, let me do entries before the acquisition date. So this will be done before the acquisition entry, remeasurement of the investments, scrutiny of the tab 3, and then the acquisition entries are done. Now let's just quickly connect some dots. The PHI concept is done. So we've done the 5th issue in this case. Now let me, I think, just quickly create some inputs in this case. So moral of the story. Moral of the story, just to give you a connected points. Now you should be clear on DC, CCE, CCS, that is with the concept of the 3-step model which I gave you, and TC, which is supposed to be expensed off. I'm right now concentrating on a quick summary chart. I'm concentrating on a quick summary chart in terms of PHI. So I want to look at the impact of PHI from 2 steps point of view. I want to look at the impact in step number 4 PC. I want to look at the impact in step number 7 in terms of journal entry. So I think if you're able to visualize this, then we're going great. So let's look at the 2 impacts. Let's look at the impact in terms of step number 4 when you calculate a purchase consideration. And let's look at the impact in terms of step number 7 when you put the acquisition entry. And trust me, here the focus will be only looking at entries in the pre-business combination period. We're going to do the entries in a pre-business combination, not in terms of the acquisition. So let's now consider the 2 cases. Let's consider the 2 cases in this case. So we can say there are 2 cases. Case number 1. Case number 1, where it is a conversion of passive. The case number 1 is a conversion from a passive to control. So I think I'll make some statements. You can vouch me as well. And we're looking at the case number 2, which is a case of significant influence to control. So let's make some statements to you. You can vouch me, and then we can just document this. Can I say in terms of the step number 4, whether it is case 1 or 2, remeasurement at a fair value and a part of PC? Agreed?
Yes, sir.
Wonderful indeed. So in this particular case, we'll directly consider this impact. Great. So we can say it is PHI remeasured. The PHI is remeasured at fair value and is a part of PC, and this remains the same even in this case as well. So this is common to both case 1 as well as case 2. Good. Now, let's look at the case 1, where is conversion of passive to a control. If it is a case of passive to control, now let me ask you a small little question if it is passive to control in this particular case. Can I say there are simply one thing? You need to scrutinize as per 109 FPT OCI or FPTPL. Accordingly, you decide the gain in the P&L or the OCI, correct?
Yes.
Wonderful. So we need to scrutinize, you can say Ind AS 109, that as per Ind AS 109, if it was taken at FPTPL, then the gain or the loss is going to be captured in the P&L. And if it is supposed to be FPT-OCI, that is NR, then the gain or loss will be in OCI. Anything else? Anything else?
Transfer to retainer.
Yes, the accumulated balance in tab 3 will be transferred in RE. So whatever is the accumulated balance in the tab number 3 will be taken to RE. No scrutiny. So whatever is the accumulated balance in tab 3, that enters in the RE. Great. Next, if you look at the second combination, that is a significant influence to a control. Can I say we are on Ind AS 28? So now focus 1, gain loss P&L, focus 2, scrutiny of OCI, correct?
Yes.
Wonderful indeed. So in this particular case, we can say the first thing is that we are applying Ind AS 28. So in terms of Ind AS 28, the first thing is the gain or loss on remeasurement will be taken in the P&L. And the second one is we need to scrutinize the accumulated balance in tab 3. We'll scrutinize the accumulated balance in tab 3 to see whether it is NR or to see it is R. If it is NR, it goes in RE. If it is R, it goes in the P&L. Wow. So that gives me a wonderful chart summarizing the positions in terms of the previously held interest as well. Wow. So now you should be crystal clear in terms of DC, step 4, as well as step number 7. CCE, step 4, as well as step number 7. CCE, nothing is done. So I think just to connect the dots. In terms of DC, we take fair value in step 4 and we do unwinding in step 7. Initial, subsequent accounting. CCE, not a part of PC, and step number 7, post-business combination Ind AS 102. Hear this carefully. If it is CCE, not a part of PC in step 4, in step number 7, post-business combination Ind AS 102. CCS, it is going to be a part of PC at a fair value. Subsequent accounting depends upon whether it's a financial liability or it is equity instruments. And as far as PHI is concerned, already there with you. TC, as far as TC is concerned, not a part of PC in step number 4. And in terms of the, you can say, pre-business combination step 7, expensed in the P&L. So when you're looking at each and every element of PC, you need to be clear what is the role of that in step 4, what is the role of that in step number 7. In fact, I'll give you a summary chart, not today, but in the next session, so you're also again able to connect the dots in terms of the initial, that is step 4, and in terms of subsequent, that is step number 7, to get the dots connected, what is done there. Everything is there at your single place. Trust me, attacking a larger, bigger question is not a problem. Now, the concept of PC is still not complete. As I so told you, that PC is a larger concept. There are two more agendas which are connected in terms of PC. One is the concept of share-based payments. That's also going to take some time. And another concept is the pre-existing relationship. That is also going to take some time. But once we're done with the pre-existing relationship, and the concept of the share-based payments, PC is done. Then it's not much area in terms of the step number 5 and 6. NCI is pretty simple, though we need to connect it a bit in terms of Ind AS 36. You heard me correct, Ind AS 36. NCI will lead to the step number 6, that is goodwill, where we need to connect in terms of Ind AS 36. So all that, of course, we'll do in the next session. Then finally, we'll pen down the summary chart of step number 7, and then we are ready to attack the larger questions. But also remember, after the 7 steps are done, there is a special issue which is pertaining to the measurement period concept. Once the measurement period concept is taken care, then we are ready to attack to the larger questions as well. So my sincere request, friends, to you, please do revise all this, because all what we have done, I know the levels are increasing, but once you do accumulated revisions, now you need to do, I think first class, even if you don't take accumulated revision is fine, but the second and the third session, you need to do accumulated revisions to get a better understanding in the next sessions with you. I think that seems to be all good for the day, unless you've got questions to ask. I'm sure you must be feeling quite discharged for the day. Okay, I get a question. So effectively, Ind AS 103 is saying to realize your gain or loss as per Ind AS 28 and complete the loop of that standard. Yes. Then come to Ind AS 103 for business combination as you realize your previously held investment. That's absolutely correct. You're right. Because once you exit out of the standard, then in this particular case, it makes complete sense. So what is the difference in PHI and a pre-existing relationship? Pre-existing relationship would be, that there are some kind of dealings with each other, not in terms of shared acquisition, but let's say, for example, some court cases with each other. So we'll see that pre-existing relationship would be, some sale purchase made with each other, some court cases with each other. That is called pre-existing relationship. Right, friends. Thank you very much. Thank you, sir, for the wonderful session. Thank you very much indeed. It was a pleasure. So we will see you in the next session. Till then, thank you. Take care. Bye-bye. Haji, thank you very much. Thank you. Same to you.